Joining us now is Francis Newton Stacy, economic strategist and CIO of Tuttle Wealth Partners. Francis, thanks so much for being here.
Yes, thank you for having me.
So Francis, when you take a step back and look at everything happening right now, a stronger dollar, lower oil prices, falling commodity prices, sort of shifting bond yields, what's the market trying to tell investors?
Well, the yields are remaining elevated because there is some risk in the system with the inflationary impacts from basically having a supply chain shock from the Strait of Hormuz that hasn't completely been resolved yet. And I think that's where the market is a little bit becoming complacent because oil prices have gone back to pre-war levels, but bond yields have not returned to where they were pre-war. And that is a little bit anticipation that the previous rise in commodities prices could potentially still put some inflationary pressure into the system. If the 60-day ceasefire doesn't end up in a final agreement, that could still really change some of the supply shocks with the Strait of Hormuz. So there's still some risk in the system, and it's still a little bit dependent on the Fed, where we have a new Fed chair and a new regime. So I think that's what the bond market is telling us right now.
So if you're a long-term investor who doesn't watch the bond market every day, what does this mean in terms of its impact on the stock market?
So basically what it does is it increases volatility in the stock market. And so it depends. If you're a super long-term investor and you feel like you have a well-diversified portfolio, you're probably not day trading the volatility, even though many people are. And so it's kind of holding pat. In general, there's a ton of liquidity in the system. So we look at like the overall money stock there's just tons of liquidity in the system. Anytime there's tons of liquidity in the system, that money is always going to try to find a home. The stock market's a great place to be. And then once you get through that layer, you sort of start looking at the relative strength. And really what we're seeing now is the fact that the AI trade, which AI is now responsible for a huge percentage of the CapEx in America. What does that mean? They are contributing to the GDP growth. And so that AI trade has a bottleneck scenario where you have shortages in memory. You have Apple, increased its prices on its devices because of that. And you're going to see more of that. And so then you have this liquidity in the system, and it's going to continue to pour itself in these areas where there are deficiencies around the rapid expansion of AI.
Okay, I want to dig into all of that a bit more, kind of starting back to being broad. You talk about the stock market being a great place to be. As you think about the second half of the year, is the stock market still the best place to be, or should investors be considering things like bonds? And then we'll dig into the bottleneck trade.
Well, bonds are now, they can be correlated with the stock market. So that's the issue that we're having, is bonds are no longer the quintessential hedge that they once were. And I mean, that's definitely some of the work that we do at Tuttle Capital Management and also Tuttle Wealth Partners, where we kind of look into replacing those mechanics, because bonds aren't a hedge. They tend to, go up and down with the stock market. And so it's not an either or necessarily. In the last several years since COVID, you've had, in some instances, more volatility in the bond market than in the stock market. So going forward this year, I still think that the stock market is going to remain elevated unless there is something where the market is being mispriced, because it is extended in the valuations, but there's so much liquidity in the system still chasing these bottleneck trades that probably that's not going to be disrupted unless you have some kind of credit event, some kind of inflation or deflationary shock, some kind of credit spread scenario. And so you kind of want to watch in the credit markets for those early signals for where the market's getting it wrong. Other than that, the market, despite volatility, is probably going to, continue higher while we have a lot of liquidity in the system.
So what areas of the market stand to benefit from this continuation higher? And if someone still believes in AI, specifically, where should they be looking?
Yeah, so AI has a bottleneck, and right now the focus is on memory and the DRAM trade. And the thing is now companies are trying to kind of find detours around that instead of trying to manage the shortage. So it's a very hard thing to watch day in and day out. Generally speaking, if you are, just connected to the AI companies, you're probably going to do well. We write and when I say we, Matt Tuttle writes a newsletter every day that is hugely long and goes into all the nuances of all of these various companies and the liquidity flows between the companies. The easiest way to do it is to access an ETF that kind of encompasses these companies so that you have somebody internally kind of trading these different things and you're not trying to actively manage that. We always have a stock that we watch every day. Recently, we've been watching Bloom Energy. They did a deal with Brookfield where they're increasing their spend from $5 billion to $25 billion. And so there you go. That's a 5x in spend. You got to watch the chart, watch the technicals if you're looking at individual stocks. We have TEM. That's basically going from a diagnostics company into a data acquisition company. It's been revealed that they have 45 million patient records and they have like 4.5 million samples. And so this is data that they're collecting. Data is becoming a currency in this environment, especially around being able to access and compile and calculate data at a record rate with the AI trade. And so for stocks, we're watching those. I'm not going to sell you our ETFs particularly, but the way that we think about this as a company, we came out with an ETF that differentiates assets from what's going on in sort of bubble land around the AI. And the thing is when, electricity is not going away, infrastructure is not going away. And so then you kind of dig into those companies and you find out who has heavy assets, because those heavy assets are going to reduce the volatility. And when you look at the traditional metrics of measuring the performance in stocks, price to earnings, price to book, in asset heavy companies, it's usually price to book. You look at undervalued stocks, that's a little dangerous because going forward, sometimes things are undervalued because they're going to become obsolete by AI. So you're looking for things that have assets that can't be replaced by AI, can only be enhanced by AI. And so we do that. There are a lot of ETFs that do that. We do that at TuttleCap. But what we're trying to find, the markets haven't changed mechanically, because mechanically you have a liquidity-driven cycle that pours into assets. It's just the performance attribution is changing around some of these AI dynamics, and we really try to be on the forefront of that.
Okay, so that ETF is the Heavy Assets Low Obsolescence ETF, HALX. I think bottom line, when you put all of this together, as you think about the second half of the year, should investors be taking more risk at this point, less risk, or simply staying the course?
Well, it depends on their personal circumstances, so it's hard to give a recommendation without understanding that. What I would do if I were an investor is I would get as educated as humanly possible about what's changing about our economy. And, at TuttleCap.com, Matt offers a free newsletter every day. It's called the Heat newsletter. We look at hedges, edges, asymmetry meaning a lot of upside and low potential downside, and themes, where we follow everything that's going on with the administration. We follow everything that's going on with all of the individual companies within the AI trade. And that's a free newsletter, and it's long, and you can pick bits and pieces of it, but you start to get educated. And then as an investor, when you start to read this information and start to assimilate it on a slow basis, then you can start to compare it to headlines, market news, volatility, and you'll see the early warning signs of things that are breaking down or performance attribution that's changing. But generally speaking, I think ETFs that are super well diversified, in particular, we don't think that the average investor is going to day trade some of Trump's Truth Social announcements or something like that. But we do that internally with the ETFs. And so you get the advantage of active management from somebody who's paying attention to that, has access to a trading desk, and you can hold those positions in ETFs. I think ETFs offer the best and cheapest diversification, as opposed to trying to do research and keep up with the day-to-day changes of all of this AI stuff in individual stocks if you don't have the knowledge base or capacity to do that.
Okay. All right. Let's transition to our rapid fire round of this or that. Quick questions, quick answers, no hedging. Are you ready, Francis?
Sure, yes.
All right, here we go. Second half, buy any dip or raise cash?
Right now, buy any dip.
Market higher or lower by year end?
Probably higher.
How much higher?
Hard to say, but I'm gonna put that in there. We have the midterm elections. We have a lot of liquidity, and unless we have any surprises, this CapEx train is going to continue rolling.
More likely to come first, all-time highs or a correction?
Probably all-time highs around increased volatility.
Momentum or rotation?
I would say the momentum trade. I think rotation is not going to last very long because I think the money is really chasing the momentum trade.
One sector you definitely want to be in, given the momentum trade?
I mean, I really think the memory story, I think it's going to get more selective, but right now it's just an overall shortage.
One you'd avoid?
I think I would avoid the rotation trade. I think it's relatively weak. I think the biggest risks in the system are any surprises around credit. But yeah, I would just keep an eye on that momentum trade.
But just be a bit more specific about the rotation trade. Like, what would you avoid within the rotation trade?
Well, the problem is that when you have this liquidity chasing the buy the dips and the momentum trade, you're not going to probably get a meaningful allocation that's going to go and stay into the rotation. The rotation might be sort of a short-term thing, but what this market is chasing, what all the CapEx is chasing, and the biggest risk to what's happening in CapEx is that it's going from cash on the balance sheets to debt, but it's still liquidity moving into this CapEx trade. People are going to chase that more than they're going to go revalue those companies. And I think when they revalue the companies, the small and mid-sized cap companies, you have that obsolescence risk kind of based into trying to get into underpriced stocks. And so I think that trade is going to be unstable. And then I think it's going to return to the momentum trade.
U.S. or international?
U.S.
International or small caps?
Hard to say. I would probably stick with the U.S. right now.
Energy infrastructure or AI infrastructure?
I think there's more upside opportunity in the energy infrastructure because the energy infrastructure is going to fuel AI. But I would watch these partnerships and mergers and debt deals, which we cover in our newsletter, in order to know where the liquidities are flowing inside of that so that you can kind of make sure that you're following the right companies.
Fed hikes, cuts, or holds by December?
I think they're going to end up having to cut.
Oil, higher or lower by year end?
Higher.
Dollar,
I think right now oil, by year end, I think the dollar is probably going to have a sell off because it's been, going much higher. Oil is assuming we're back to pre-war, and I think that that's an erroneous assumption.
Gold or Bitcoin?
Gold.
One word to describe this market.
Ever-changing.
Frances Newton Stacy, economic strategist, CIO of Tuttle Wealth Management. Thanks so much for playing along. Really appreciate your insights as well.
Thank you. Have a great one.
If you enjoyed this Street Talk, check out our full interview with Brian Levitt. He explains why we're entering a new phase of the bull market and what to do about it.